So the reverse repos are done. There's practically no more of them. I think the last one was like 3 billion, which is basically nothing. So the quantitative tightening, the QT, the shrinking of the balance sheet that the Fed has engaged in since it started at the peak of the balance sheet was sometime in 2021 for the last 4 years, maybe 2022. I don't remember. It's all blurring together. All this COVID and the printing and AI, it's all kind of like mushing together in my head. Whatever's happening in the world. So since the Fed started QT, they've been shrinking effectively the reverse repo amount, which is money that's outside of the banking system, and now it's no more. So all the QT it has been draining bank reserves, and bank reserves are used as the grease, as the slime that coats the repo market. That's the money that's being traded. Those are the dollars that are being traded every night, 3 trillion of them, the bank reserves. Now, I had a theory which ultimately proved wrong. I don't think it's in principle wrong. I just think that I missed a technical aspect that I suspected I might have missed, but I didn't really take it seriously. I thought that the amount of reserves could not be less than the amount of repos that are traded every night because they're trading the reserves. So it turns out they can. I just don't know by how much. I don't think by that much. So right now the ratio the bank reserves are falling. They're now at like 2.9888 trillion, like below 3 trillion, and this week's number, which should be out in a few hours, and in 2.5 hours it'll be out and I'll check it. It should be like something like $80 billion less because the government shutdown, right? It means that the government isn't spending as much money. It's spending, I think, on mandatory spending, but not on discretionary or something like that. I don't know exactly what the technical details are, but it's spending less money than it otherwise would. So all the money that's sucking out of the bank system is not being spat back into it. So they're raising money. I think the total dollar cash hoard that they have is like $930 something billion. It was whatever it was like $60 or $70 billion more than it was last week. So that's money that's taken from reserves. So yeah, now you have 2.988 trillion minus about 70 billion, so it's like 2.91 trillion or something, and the amount of repos that are being traded is over $3 trillion. It's like 2.98. It fluctuates between like 2.95 trillion and 3.0 or 3.1 trillion, something like that. Like how much longer can this go on? I mean, we're looking at the repo rate. It's called the SOFR rate, and it keeps wobbling. It wobbled again 2 days ago, up 7 basis points, and now it was down 3, and tomorrow it could be up 10. Who knows? If it's already wobbly, that means things are already tight. And the standing repo facility that the Fed instituted after COVID, it provides emergency repo money to banks that can't get it because maybe the reserves run out. It's being used. And sparingly, like a few $1 billion a night, but it is being used now. It wasn't being used before. So we know that some banks are out of reserves, so they can't get any. So there is a shortage here. It's going to get worse as repo trading keeps expanding, as it does, because you have all these hedge funds that are, I don't know, trying to pick up pennies with basis trades. I don't even want to go into the technicals of that. It's just you're trading around dead zombie money and earning a few pennies on levering it up like 50 times each night. So this is going to end. And it's going to end soon because the repo rate is already moving several basis points a night. It's already tight. If you read these books on hyperinflations, isolated hyperinflations in the world, I remember reading once, maybe it was When Money Dies. I forgot who the author was, but it was about Weimar. And he was talking about during the late 1923, when the hyperinflation was in full swing, you had government agents of the Weimar Republic just like raiding people and stealing whatever hard money they had on them to try to get ahead of the hyperinflation, where they had gold coins in their pockets or silver coins. And they even outlawed platinum because some people were hoarding platinum and using platinum for exchange because they couldn't use the stupid paper mark. So even back in 1923, platinum was still being hoarded as some kind of a money, as some better money than paper money. So the reason platinum would be disjointed, not necessarily because there's a sudden demand for catalytic converters or whatever, platinum is used for primarily. And that's primarily catalytic converters in cars and other strange niche-y kind of things that I really have no understanding of. I don't understand car parts or anything like that. But since it is a pseudo money and the liquidity is so low, people could think, well, gold's too expensive. It's like $4,400 an ounce. I mean, there's probably a little bit of a physical premium on it. To get an ounce would probably be $4,400 today, despite the fall. and they might get some silver, but they might also want something that's more value dense just to preserve their wealth, and they don't want gold, and they think the platinum's really cheap because, you know, they think of the 90s and like, okay, well, platinum was much more expensive in the 90s than gold was. That's why like the platinum credit card is considered a higher line of credit than the gold credit card, you know, that's left over from that decade. So in their mind, platinum could be more valuable. And as markets shift from industrial to monetary, industrial demand is demanded by the creators of whatever piece of capital equipment they're producing for industry, right? Or consumer good. But monetary demand is by definition everyone. So even the slim amount of monetary demand would be more than the very specialized industrial demand for platinum. If you have even a tiny percentage of monetary wake up of people looking for a preservation of value and they don't want gold because it's too expensive, then they'll see platinum is cheaper, so want to take that. Maybe they'll go for it. And that could overwhelm the very, very thin platinum market as it's overwhelming the silver market, which is why you're seeing all this disjointing through London and New York. What that means just very broadly in a broad brush strokes is that the monetary demand for silver is starting to wake up, and the silver market is not structured for that. It's structured for silver as a commodity, and it doesn't have the capacity to satisfy the demands of people who are demanding silver suddenly as money because they're panicking.
Let's take a deep breath and look at where we actually stand in this monetary drama. Because right now, everyone's running around like it's already the final act. It's not. We haven't even hit the real fireworks yet. The next money printing run hasn't begun. The reverse repo facility, the Fed's convenient outlet for excess liquidity, is practically empty. The last print I saw was around $3 billion, which is basically nothing in a financial system that eats trillions for breakfast. That piggy bank is done, but the Fed hasn't yet stopped quantitative tightening. They're still shrinking the balance sheet, albeit more slowly. Rates are still high. The Fed isn't buying bonds on net, and we haven't reached the point where they cut rates to zero and go full panic mode. In other words, we're not yet at the part of the movie where the hero dives into the vault and hits the big red button that floods the system with cash. That's what makes this moment so remarkable. Gold has already gone so far, so fast, without the printers roaring. It's as if the market is front-running the next crisis. You'd think gold would need an explicit round of QE to take off, but here it is, breaking records before the next round has even started. That tells you something profound about confidence or the lack of it. The global financial system is already bracing for the storm, but don't get carried away. Gold won't just go up every single day until the Fed caves. We're still in the intermission between acts. Right now, the dollar is still in what I like to call a perpetual short squeeze. There's always more dollar-denominated debt in existence than there are actual dollars to settle it. That's the nature of a debt-based system. Every dollar is created as debt, which means the total debt load always exceeds the money supply. So when defaults begin, or when liquidity tightens, it's like a global game of musical chairs. Everyone scrambles for the remaining dollars, and the music gets louder until someone trips. And when that happens, gold and silver don't escape unscathed. They sell off too, just like everything else. Stocks, bonds, even Bitcoin. It's not because they've failed as safe havens. It's because in a liquidity crunch, people sell what they can, not what they want to. Gold sold off in March 2020, right in the middle of the pandemic panic, dropping to around $1,450 before rebounding ferociously. The mining stocks got obliterated, down 30, 40, even 50% in a few trading days. Everyone screamed deflation, but that was just the warm-up. Then came the real show, the money tsunami. The Fed printed trillions out of thin air, cut rates to zero, and started buying everything from treasuries to corporate bonds. And gold and silver did exactly what they've always done. When the money printer starts humming, they exploded higher. Day after day, week after week, limit up, no pullbacks. You could set your watch by it. That's the pattern we'll see again. Only this time it'll be magnified by the sheer scale of the debt bubble. But here's the key. We're not there yet. We're still in the tightening phase. The dollar short squeeze is ongoing. The banking system is starting to wheeze, but the Fed hasn't panicked yet. When it does, when the defaults start and liquidity freezes, that's when we'll see the next round of printing. Until then, There'll be corrections, fake outs, and plenty of noise. Now let's look under the hood at what's happening in the plumbing of the system. The bank reserves, the lifeblood of the repo market, have fallen below $3 trillion. They were around $2.988 trillion last week. Maybe $70 or $80 billion less this week thanks to the government shutdown. Why does that matter? Because these reserves are the grease that keeps the overnight lending markets running. Banks trade these reserves with each other every night in the repo market. Without enough grease, the engine starts to seize up.
I think the most important point here is to take a step back and to realize that we are not yet in the final sprint to the end game because the next printing round hasn't even started yet. Right? The reverse repo extra money bank has been depleted, but the Fed hasn't stopped QT, hasn't stopped shrinking its balance sheet. It's slowed it down, but it hasn't stopped it. It hasn't cut rates to zero, and it hasn't started buying bonds net yet. It just, nothing is happening. And the fact that gold has gone so far so fast before the next printing round has even started kind of surprised me. So my point is that gold is not going to go up and up and up and up every single day until the next printing round starts. I mean, just like it was in COVID, the Fed cutting to zero immediately because there's a bank scare, or JP Morgan says they have to, whatever it is, the big banks come together and say, Fed, we need you to move. And then they print twice, 3 times, 4 times as much money as they did during COVID. Then gold and silver should go up and up and up day after day after day without any kind of pullback at all. But we're not there yet. So until we are there, the dollar is going to be in a perpetual short squeeze, meaning there's always more debt than dollars exist. So at the point when somebody starts defaulting, then you have, it's like a game musical chairs where the music stops and everybody's got to sit down, and whoever sits down last doesn't get a chair. So when the music stops and defaults start, that's when there's a rush for dollars, and there's going to be a big rush for dollars at some point, and gold and silver are going to sell off just like everything else. It's just that gold is going to sell off less than everything else, just like it did in COVID. Gold sold off during the lockdowns. It did. And it reached a low of 1450, and the miners got clobbered, I don't know, 20, 30, 40% in a few days. I don't know if it's going to be that magnitude this time. It's going to be the same kind of thing. And then the Fed's going to reinflate. And then at that point, we can say we're in the final sprint. It's going to take a few weeks until the dollar collapses. But we're not there. We got to wait for that to happen. And meanwhile, we can play the game of, well, what was the proximate cause that made gold and silver fall down specifically on October, whatever it was, 21st. And then we could look at the movements in the market. But that's all inevitable. It's always the same story. There's going to be something that is going to cause a correction until the Fed reinflates. So wait for that to happen, and then you can say that there's going to be no more corrections. But until then, you got to stay balanced. We can't be too euphoric, and we can't be too discouraged because we're still in a dollar short squeeze where there's more debt than dollars that exist, and that's what's going to happen.
We saw a little bit about performance on that last leg by silver, but really gold and silver moved together for the most part. So that signals that we aren't at a blow-off top stage. Can you share a little bit about this, the gold-silver ratio, and what that signals to where we are in the bull market?
Yeah, you can come up with 1,000 reasons why it happens. But before we go into the reasons why, we just have to remember that this is what has happened every time since 1918. Since the end of World War I, which was the end of a huge inflation that funded the Great War back then. And then at the end of that inflation, silver outperformed gold until a silver dollar was worth more than a gold dollar. Not that silver was worth more than gold, but if you had a silver dollar coin versus a gold dollar coin, I think they had those coins back then.
So what happens next? The first signs will be visible in the repo market. We'll see volatility spike, funding spreads widen, and the software rates start behaving erratically. The Fed will pretend everything's fine, then quietly intervene with temporary liquidity injections. They'll tell us it's technical. It's always technical until it isn't. Once the pressure builds enough, maybe a bank failure, maybe a bond market freeze, they'll have no choice but to reverse course. Quantitative tightening will end. Quantitative easing will return. But this time, it won't be limited to treasuries or mortgage-backed securities. It'll be everything: corporate bonds, municipal debt, maybe even equities. They'll flood the world with dollars to prevent the dollar from imploding under its own scarcity. And paradoxically, that's when the dollar really starts dying, not from strength, but from excess. When that happens, gold won't just rise, it'll go vertical. Silver will follow, and then platinum, the forgotten metal, will suddenly become the new money for those priced out of gold. Imagine average investors looking at gold at $4,400 an ounce thinking, that's too expensive. I'll buy silver at $75 or platinum at $1,200. That shift in perception will send shockwaves through these tiny markets. Here's what people forget. The monetary metals market is microscopic compared to global capital. All the gold ever mined is worth around $15 trillion at today's prices. All the silver above ground, maybe $1.5 trillion. The platinum market, barely a rounding error. If even 1% of global financial assets decide to shift into hard money, you'd see price multiples, not percentages. That's the setup. Meanwhile, the banking system is already wobbling. You can see it in the data if you know where to look. The Fed's balance sheet has shrunk, yes, but at the cost of draining the very reserves that lubricate the financial system. The Treasury's general account, the government's checking account at the Fed, is ballooning again because Congress can't stop spending. That's sucking liquidity out of the banks. You can think of it like this. Every dollar the Treasury raises in taxes or debt issuance that doesn't get spent immediately is a dollar pulled out of the banking system. Those reserves are disappearing, and as they disappear, the repo market, the core of dollar funding, gets more fragile. It's a slow-motion bank run at the institutional level. When the crunch hits, the Fed will step in, as it always does, but the psychological damage will be done. Confidence is the only thing that keeps fiat alive, and confidence is already fading. That's why gold is soaring before the printing starts. The smart money sees what's coming. Now let's circle back to silver. The silver market today is like a tightrope stretched across two worlds, the industrial world and the monetary world. For decades, silver's price was dictated by industrial demand, solar panels, electronics, medical devices. But as inflation bites and faith in fiat crumbles, a new buyer enters the scene. The saver, the citizen, the retail investor who just wants something real. That's why you're seeing chaos in physical premiums, delivery delays and dislocations between paper and spot markets. The monetary demand is waking up, and the market structure isn't ready for it. The same thing happened in gold in the late 1960s. Back then, the US still claimed to redeem dollars for gold at $35 an ounce, but physical demand was exploding. By 1971, the system broke. Nixon closed the gold window and gold revalued overnight. What's happening in silver right now is the same dynamic, just faster and with more leverage. And remember, silver is far smaller than gold. It doesn't take much buying to blow it sky high. Now I can already hear the skeptics saying, but Rafi, silver's volatile, it's manipulated, it's unpredictable. Sure, it is all those things, but so is every market in transition. When money itself is breaking, the things that represent real value will move violently. That's not chaos, it's price discovery. We're watching the slow death of financial repression. For over a decade, savers were punished, debtors were rewarded, and central banks pretended they could fine-tune the economy by adjusting the cost of money. That illusion is collapsing. The market is retaking control, and it's not going to be pretty. When the Fed finally panics and reopens the spigot, it won't be a gradual rise for metals, it'll be a moonshot. You'll see gold up $200 in a day, silver up $5, $10, maybe more, and platinum tripling before most investors even notice. And here's where things get really fascinating. As the monetary tide shifts, the psychology of value changes. People stop thinking in terms of price and start thinking in terms of preservation. They stop asking, what's the yield? And start asking, what will still exist tomorrow? That's when gold becomes untouchable, silver becomes scarce, and even platinum becomes a symbol of stability. Now let's put this in historical context. In Weimar Germany, as inflation spiraled out of control, people hoarded gold, silver, even platinum coins. The government eventually banned them all. They even outlawed the possession of platinum because people had started using it as underground currency. Why? Because monetary demand, once awakened, is unstoppable. Industrial demand is finite. Monetary demand is infinite. It's everyone all at once realizing they've been holding promises instead of money. That's exactly what's happening now. We're seeing early signs of that awakening, small at first, but accelerating. The disjoint between London and New York silver prices, the rising premiums, the dwindling physical supply. These are symptoms of a monetary reawakening. When the Fed finally breaks and restarts QE, that spark will become a wildfire. People will flood into metals not just for profit, but for survival. And the system, designed for leverage, not settlement, will seize. The final stage will look chaotic. Repo markets breaking, currencies fluctuating wildly, stock markets whipsawing, and through it all, metals rising, not smoothly, but relentlessly. And at that point, we'll see something new, the re-emergence of money as something tangible. Maybe not a full return to a gold standard, at least not right away, but a psychological shift. Gold, silver, and yes, even platinum will reassert their roles as the foundation of value. So don't get lost in the noise. Don't fixate on whether silver's $26 or $29 this week. That's irrelevant. Focus on the tectonic shift happening beneath the surface. The reserve system is hollowing out. The grease that keeps the global financial machine running is drying up. And when the engine finally seizes, you'll see the greatest transfer of wealth in living memory, from paper holders to metal holders. That's the end game. It hasn't begun yet, but it's coming fast.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.